Looking at long-term money supply, inflation is baked into the cake. Let's see exactly just how much. Hello, this is Chart GPT. Today, we're looking at the long-term money supply and how much that a lot of people believe that the money supply indicates potential inflation going forward. So we want to take a look at a chart here. And this is all sectors, debt, securities, loans, liabilities, kind of indicating how much money is in this system here. And of course, this is coming from the Fed. You can see the series there. And what's interesting is looking at the trend lines here. And it basically took us 24 years, starting in around the 1987 period to about 2012, to print 40 trillion in, not necessarily print, but create $40 trillion in 24 years. And of course, then it only took 12 years to do another 40 trillion. And so looking at, that's where we're at today at about 95 trillion. And then if we go further, and how long would it take if we use the same, just everything being the same, looking that we, in the next 6 years, we would create another 40 trillion. And of course, you can see the halving of the time period. So another 3 years after that. So by the year 2029, we create another 40 trillion. So we're going to get close to 175 trillion. And you begin to see that it's basically halving in the time it takes to create that money. And so we're creating an exponential curve. Of course, it's been often said that money is debt. And so the value of money is often described as the GDP, gross domestic product, divided by the monetary base. So we would take the 95 trillion then divided by the GDP, and you get the supposed value of money. Now, if you increase the monetary base of, and not increase the GDP, i.e. printing money or creating more credit, you obviously reduce the value and you create inflation. If you can keep the monetary base the same but increase the GDP, your money gains in value. And of course, we see this work itself out in the Forex markets. So now, using that formula, we can kind of begin to project where we're at. Of course, we saw the chart and we had the extension of that, showing that arc of the exponential curve. Today we have about a 25 trillion, these are in trillion by the way, in GDP, and about a 95 trillion monetary base. And then if we extend that six years and we create another 40 trillion, we're going to have 135 trillion in the monetary base, and then 28 because they increase the GDP. And of course, we're just assuming a 2% growth rate. And then again another 40 trillion, again in the half-life of that time period to 9 years, which brings us to 2029. So it's $30 trillion economy with 175 trillion in debt. So you take the implied inflation rate from where we're at today to where we're going to be in 2026. So that gets about a 6.5% inflation rate. And then by the 2029, it brings us close to 9% inflation rate. Now, of course, that's assuming a steady growth of 2% GDP growth and the continuing as we are today. Now, keep in mind, these calculations of implied interest rates are the core. You'll have, sometimes it'll extend as much as twice the rate in peaks and valleys. So we could be up to, instead of the 9%, we could be looking at 18-20% inflation rates on peaks, and then the valleys could be even lower than the 9%, so keep that in mind. Now, if you don't like any of those numbers, you'd have to either somehow increase the GDP or reduce the monetary base. So the point being is, anything that would take us off that curve would be a significant effect in terms of the way the economy is. If you want to reduce that, you're going to have a significant recession, or even worse, a depression. If it gets worse, obviously those numbers go up. So some of the things that might cause that is, on the upside, we could have pro-growth policies and also new innovations. I know some people think AI will be to be able to increase that GDP number on the top side of that equation. That might be overstated, but there may be new innovations that can drive that. Of course, on the downside would be the inverse, the anti-growth policies. Basically doing more meritless socialism and redistribution of wealth type things, as well as black swan events, which is typically what's happened in the past. 9/11, pandemics, world wars, this kind of stuff. So black swan events could cause governments to want to accelerate that and spend more money. So any of these kind of effects would change that curve. But what I would present to you in the original chart was that the kind of the default position. Now this is going to happen no matter what we say, this exponential curve in growth is going to happen no matter what we do. Take a look at the AI in terms of what other things that could cause inflation other than money supply growth, supply chain, things like this, and the AI gives you that. And give us your prediction. Is this chart that we're seeing here, is this default inflation curve going to happen, or is there going to be a significant event either on the upside or downside that will cause this, shall we say, default inflation picture to occur? In any case, this could be a very frightening event, and this picture could be one of the most important charts that you see as you begin to think about your future. Don't forget to subscribe.